Jevons Paradox is the economic principle that states that increased efficiency can lead to increased consumption. Welcome to the third episode of Kurv Your Enthusiasm. We are your host, Howard Chan.
And Dominique Tersin.
This podcast is a discussion of everything relating to investing and everything adjacent to it. It is important for us to remind the listener that the trades we discuss on this show are not meant to be financial advice. Today's episode, we're going to cover what's happened in the market and some news updates. The market we're going to cover on this episode is the currency market, and the trade of the episode is going to be related to that, which is the carry trade. So Dom, since we last recorded, actually right after we pressed stop on the episode, lots of things has happened. So what has happened in the market?
What has happened? Well, since 2 weeks ago, equities did very well in the US, like in all over the world. S&P is 1%, Nasdaq 3%. That's pretty good. And despite some volatility around macro data, we had employment slightly weaker. Higher inflation than anticipated. On the CPI, the PPI, the wages as well. We had gold, which is up 5%. And that's an all-time high. Again, super resilient. It's relentless on this move. And we had some news on the big techs. So we had Google and Amazon who reported earnings 2 weeks ago, a week ago. They both beat earnings, but somehow it wasn't sufficient for the stocks to rally even more than they did before. So they were a bit disappointing in the cloud business. And what did the stocks do on what we follow on the tech side? We had the Microsoft, so Amazon, Google, down from 1% to 8% for Google. We had Tesla down 11%, and we had Netflix up 6%, Meta 4%. And we had the hardware companies like Nvidia, Broadcom, Cisco up some nice 7 to 12%, which in a way is what you said last time, Howard, right? On your rationale that the hardware companies would do rather better than the cloud business.
Yeah, I started the top of the episode with this Jevons Paradox, which apparently is the most searched term people did after the DeepSeek announcements. I didn't really know this economic principle, but it did reflect what I said in the episode before this, which is that, compute for me is sort of like energy. When you make it more efficient, there's more demand. There's actually increased consumption of that. And it seems like a lot of the hardware, specifically chip makers, have rebounded since we last recorded our episode, not to its all-time high, but there's some sort of version there. So I'm glad that the market has reverted, and we'll see where it goes from here. I think it's very important. But also, I think, Dom, what we have discussed in the previous 2 episodes about where we think the rate path is going to go, as well as where inflation might be, is also seem to be coming at least partially true.
Yes, yeah. Look, we have the move in the yields. Well, the 10-year didn't do a lot, just up 3 basis points since we spoke. But the December Fed funds was up 12 basis points, meaning that there is less cut expected by the market. And that's probably on the back of the inflation number, right? Inflation were on the strength side.
Yeah. So certainly labor market still seems, pretty strong, although I think it's softening a little bit.
It has
but definitely inflation is coming on still pretty stubborn. So I think the market has repriced itself to have even less probability of a rate cut towards the end of the year. So that has been our thesis going forward.
So more inflation, slightly less growth. That's like stagflation vibes. And probably why gold is up, right? 5%.
Yeah. So far, the market is reacting in a framework that makes sense. In our very first episodes where we focused about interest rates and the linkages to that, one of the things that we posited that the Fed maybe are taking some rate cuts away is because they don't know where fiscal policy is going to go. And it seems like that theory has now also turned out to be pretty accurate, because as we finished recording our last episode, there was an announcement from the White House about tariffs. So for those who are not familiar with tariffs, is that if you are an importer in the US and you're importing items, products from overseas, when the tariffs is imposed, the importer has to pay an extra amount in order to import that product. So that's why many people consider tariffs a tax on goods. And it's not, the effects of tariffs is sometimes uneven. We've seen tariffs being raised in the last Trump administration on steel in particular. And what we saw was there was some resurgence in American-produced steel, but really the folks that it affected the most are actually the consumers of steel, and that would be the auto companies in the US. They saw an increase in their input products quite a bit. So Dom, what was actually the announcement of tariffs after our last episode?
Yeah, in 2 weeks, we had some back and forth between the Trump administration and other countries. The first one was about Mexico and Canada with increased tariffs, but that has been postponed for now. The second was the steel again. Is back. 25% tariffs on steel worldwide. The third one was a story on the VAT, value-added tax, which is a tax in Europe. We have that for sure. It's considered by the Trump administration to be like tariffs for American products. So they would want to have a reciprocal mechanism on those tariffs. Not sure I would agree with that, but that's their point of view anyway.
I think maybe for me to start on the last point is I think that's sort of a misunderstanding of how VAT works. But if you're going to say something or say anything, you could say anything, I guess.
Because you do, in the US, you do have sales tax, no?
We do have sales tax. The VAT is essentially a pass-through from producers to all the way down to the end product, right? And you pass through that tax and you don't tax until the very end. You don't tax all the way through the supply chain every time a product changes hands.
And it's wherever the product is being produced.
Yeah. I think the misconception is that the VAT is applied on all products within a border, not just imports and outputs. So I think that's... Again, if you want to make a case of anything nowadays in the world, you can say whatever you want. But going back to sort of tariffs, we should be careful in terms of making a broad comment about the effects of tariffs. And it's very important to actually see how the tariffs are imposed. The way that tariffs are imposed is that there is a commonly agreed list of items and categories around the world. When you apply tariffs, you're applying a specific rate to those different categories. And I say why it's important is because the last time the Trump administration raised tariffs, we have actually seen a lot of American champions, for some reason, get excluded from tariffs. Can you guess, Dom, which American company almost had no tariffs being imposed on its products?
Yeah, I think it's a big smartphone company, among other things.
Yeah. So it ended up that even though tariffs was imposed, different individual companies can actually submit exemptions from tariffs. I believe Apple, if I recall correctly, applied for 6 or 7 exemptions, and most of the components of Apple products seem to be exempted from the last round of tariffs. So we have to be a little bit careful and not be too broad strokes about it's a broad tax across everything. We do have to see the effects of tariffs on these individual product categories. The tax will be passed on to the consumer of that product. It's just that the consumer are different groups than we would typically probably expect.
And there is a lot of leeway and loopholes, I guess, on the supply chain. I believe since Trump episode 1, manufacturers were going through not through China, US directly, but through other countries like Vietnam.
That's the thing that interesting about finance is that whatever you move, your move is, there's a counter move. And if there is a loophole, somebody will find it. And then that will also have a secondary unintentional consequences in the market. The tariffs was announced initially with against Canada and Mexico, and we've definitely seen currencies, the Canadian dollar and Mexican pesos, move relative to the dollar. So Dom, what actually happened this is a segue to talking about the FX market. So how did the FX market move?
On the announcement, you will see a Mexican peso and Canadian dollar going down against US dollar. That's very short term, usually, the effects. After it moved back because it was postponed, what we've seen in the past 2 weeks on the dollar index is the dollar was actually down 1%. The way it was already up maybe as an anticipation towards the tariff talks. So kind of, what do we say?
Sell the fact, buy the rumors.
Sell the fact, yeah.
The reason why we wanted to talk about the FX market is because it's actually an important risk exposure if you're looking to invest outside of your domestic market. Many US dollar-based investors don't really have to think about currency risk because for the past 10, 20 years, the US dollar and US market has been pretty strong. But this is not true for non-dollar investors. And an example that I wanted to give was in 2024, Japanese equities had a phenomenal year. So if you take a look at Topix, which is where the exchange where most Japanese equities are listed, it actually increased, provided a total return of 15%. But if you were a dollar investor, you didn't get 15%. You got about 3 to 5%. And that's because the yen depreciated against the dollar by almost 10%. So that 15% rise in equities, Japanese equities, was offset by 10% depreciation in the yen for the dollar exposure. When you buy a foreign security, meaning a security that is not denominated in your base currency. So if you're a US investor, your base currency is US dollar. If you're a Canadian investor, your base currency is Canadian dollars. When you buy a security or an investment that is not in your base currency, you will have FX risk. Dom, I forgot. How big is the FX market?
It's pretty big. I looked up some data. It's these days, it's about $7 trillion exchanged every day.
The FX market is probably by most measures the largest market in the world. The reason is because its risk exposure for FX is usually attached along with other assets that you can buy. For example, when you're buying Japanese equity unhedged, you're not just getting a Japanese equity risk premia, you're also getting an FX risk premia. If you're getting a Canadian bond, you're not just getting bond risk, but you're also getting a Canadian dollar risk. So almost every single asset that you buy outside your home currency is part of this currency market. So Dom, let's maybe go through a little bit on what are some determinations of exchange rates that you look for when you're looking at how currencies appreciate and depreciate.
We can look at the supply and demand, what affects both. On the supply side, what you will have is the most important to me is monetary supply, so monetary expansion. How fast supply of one currency happens. That's usually because of what the central bank does and what's their policy. And on the supply side, you have also who sells the currencies. It's usually the importers. So if you have a country that is more biased to importing stuff from abroad, they will have to sell their currency to buy the other currency in order to get the products. On the other side, on the demand side, you will have the investors in your country, and in the same way, you have the exporters. So if you are Europe, China, or Japan, all the exporters will receive your US dollars, but then they will have to exchange them back into their own currencies. So it's a demand for their own currencies. That's what you have. But in a way, as I said, the most important is probably the monetary side. That's affected by financial data. And the big one is interest rates, usually on the shorter part of the curve. Inflation. So you need to compare interest rates and the inflation in the country, which at the end, it's called real interest rates minus inflation. And the macro data. Expectation on what the country is going through and their trade balances. But to me, this is the most important. And the short-term effects are because of interest rates and central bank decisions.
For me, FX is sometimes the more complicated thing to think about because everything lives in relative world, right? If you buy, let's say you're a dollar investor, you're buying treasuries, you're thinking about supply and demand in the treasury market, and usually you're comparing that maybe as what you get relative to cash. So like the comparison is relatively straightforward. But in currency space, everything is a relative basis. So you have a basket of currencies that's competing for global trade flows, balance of payments, and the pound can strengthen against the dollar. The euro can strengthen against the dollar, but what does the pound do relative to the euro? And that has effect on the dollar as well. So everything kind of is connected in a way. You mentioned one of the determinations of currency rates is short-term real rates. And even there, it's a comparison of short-term interest rate relative to two different currency regimes. Maybe let's go back to the currency pair dollar and yen. The idea is that the currency that has the higher, shorter interest rate tends to, over the long term, have a strengthening currency. So the US now has, for the last year or two, have a higher short-term interest rate than most of the rest of the world. And we've seen a strengthening of the dollar compared to non-dollar currencies. And that can be explained by a couple of things that Dom just mentioned, which is generally when you have higher real rates, which means that your economy is doing better. So that means that you're generally have a stronger economy, which attracts foreign investments or maybe domestic investments, which increases demand for the dollar. That is a long-term signal for currency appreciation. But if you have high inflation, that also depreciates your currency, right, Dom?
Yeah, at the end of the day, inflation, as Milton would say, is a monetary phenomenon. If you have interest rates that is set by the central bank at 5%, but your inflation goes through 20%, well, what's the point of having this currency, right? So you need to take into account the real interest rates, ideally. In a way, in finance, it's always not so much what we have now, but more of the expectation. You could have a 5% interest rates and a 20% inflation. As long as the market expects this inflation to go down, that should be a good way for the currency to increase, to compensate for that. But in general, positive real interest rates should be good for a currency, which is the case in many countries.
Many people compare short-term real interest rates to currency strength, and they do make positions in currency. Then a common trade in the currency market is known as the carry trade. This is made famous really in the 80s, where it was also known as the kimono trade or Mrs. Watanabe trade. The idea was, or at least the fiction is that you have all these Japanese housewives who are sitting in front of a computer making these carry trades in their portfolios. But in reality, that's actually was not true. Most of the people who are doing carry trades were actually probably men in banks. So this is a fiction, but it is more prevalent for Japan. So maybe Dom, do you want to maybe describe what a carry trade is and
Sure.
why it makes sense for, at least in the past, for yen domiciled investors to do a carry trade?
Carry trade is borrowing in a low rate currency. So like Japan, the current 3-month rate is 0.3% only. Selling this currency into another currency that has a higher deposit rates, like in the US at 4.3%. So you pick up this 4%. Not too complicated, but as you said, Howard, it's risky because when you borrow that money and change it back into another currency, there is currency risk.
So what that means is that even though you could potentially lock in this 4% rate differential between the US and Japan, the change in currency rates can overwhelm that 4%.
Yeah, exactly. For example, I think last year or 2 years ago, I can't remember, it might still be the case. You had Turkish lira, massive interest rates, like 30% or something. But, can depreciate 30% in 3 months. So, you have to be careful.
So maybe we can talk about what are favorite currencies to borrow from and what are currencies that people generally want to invest in.
You want to borrow from a currency, well, first, with low interest rates. These days, there are not many. It's usually Japan or Switzerland. Switzerland have even lower rates than Japan. Ideally, you want the central bank that moves, well, that's still a path with oversupply of the money, or at least an easing bias to the money. You would want economic growth to be less than expected. So ideally, in Japan these days, it's probably negative. So the positive will be, well, it's low interest rates. Inflation is 1 to 2%. It's negative real interest rates. So that's good. But the central bank is trying to get away from the easing bias that they have. So that's a bit risky. It's something to take into account. And the other way, you want to invest in a country with high interest rates, growth, and a growth path that is still ongoing, at least more than what is expected by the market, and their central bank that has a tightening bias that is, again, more than expected by the market. It's a bit difficult to time. The risk is, market timing to get compensated for the risk you take. It offers a cushion. The dollar-yen trade these days offers a 4% cushion, a 4% carry that you make. If the dollar-yen stays unchanged for 1 year, you make 4%. It's not bad, but dollar-yen can move more than 4% in 1 year. So that has to be taken into account. So ideally, there is a good timing issue there to make.
Yeah, I think a lot of people would say, currency trades are generally zero-sum games. Like somebody has to lose in order for somebody else to win.
Yeah, and there are different ways to do the carry trades. The most common ways is to do via FX forward. It's a derivatives. Derivatives are zero-sum games.
Oftentimes, carry trades are not just done on developed currencies. They're also done on emerging currencies, or other terms as developing currencies. So talk us through a little bit about that.
Yeah, it's the carry trade on emerging. The usual example are yen, you borrow at cent, and you buy Brazil currency, Brazilian real, and you put your deposit there at 13%. Pretty good, right? So it's you have a 13% buffer to get compensated for the risk you take per year on the Brazilian real, Japanese yen. It can move 30%, but it can move your way, by the way. The Brazilian real can increase if the Central Bank of Brazil becomes more hawkish, if the economy does well, inflation going down. By the way, inflation in Brazil, I think it's about 7%. So that's a 7% positive real rate. That's usually attractive. You have the same in South Africa. Rates are a bit lower, in the 8%, but real rates are still positive there. So there's pick up there. So that's usually the common trades we see. There's some more funky currency that I said, like Turkish lira, but that's very speculative.
Okay. It's always interesting to see the consequences of differences in short-term interest rates. I think this is another example why short-term interest rates is very important. So that concludes our third episode of Kurv Your Enthusiasm. If you enjoyed this episode, please like the episode and share it with your friends. And we hope to see you on the next one.